Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Menasce. This is the weekend edition where we interview notable people from the world of real estate investing. Today is no exception. We have a great guest all the way from Lynchburg, Virginia. Welcome to the show, Paul Moore.
Hey, great to see you again, Victor.
Great to have you here. You've been on the show a few times, and it's been a little while since you were last on the show. I know the last time that you were on the show, you had pivoted out of straight equity into pref equity, and lots changed in the market over the last little bit. Love to get an update on what's transpired, but maybe before we do, perhaps give a little bit of your backstory and how you got to this point in your journey.
Yeah, almost 30 years ago, I sold my company to a public firm, and I viewed myself as a full-time investor. And Victor, I wasn't. I was a full-time speculator. I should have known better. I had an MBA, but I didn't. And I made tons of mistakes, lost a lot of money. I made a lot of money as well. You know, I had a podcast I think you were on called How to Lose Money.
Yep.
It was a wealth building podcast, to be clear. But at any rate, we eventually launched Wellings Capital 11 years ago. And we began investing as an LP in large commercial deals. That's after I'd already done about 15 years of residential real estate investing. We pivoted from being a multifamily syndicator to actually launching funds. We have 8 funds now where we invest in a broad variety of things like self-storage, mobile home parks, light industrial, commercial retail, and multifamily.
Love it. And to be clear, your focus is primarily on the value add side. You're not doing any development or new construction, right?
Yeah, that's right. That's right. And we don't operate any of these deals. We could never be experts in 5 asset types and 100 geographies. We find the best operators we can, especially those who they're way better operator than they are a promoter. And we bring money to their deals.
So lots changed in the market. There's some growing signs of distress in the market, in particular multifamily. We're starting to see, I'm just quoting publicly available numbers, default rates in Fannie Mae are up to, I'm going to say, almost 2010 levels at the bottom of the great financial crisis, almost on par with what we're seeing back then. The CMBS market, likewise. And now, of course, to be clear, a lot of the distress in the CMBS market is driven by office, but even in multifamily, default rates are 6-7%, those are very high numbers compared to what we saw a few years ago. What are you seeing in the market?
We are seeing that. You know, I've got a bunch of friends and competitors who we join a mastermind once a month, and the pain in that group was pretty high last month. And it just, I think everybody's given up on the chance that we'll see a 1 or 2 point drop in interest rates anytime soon, maybe ever. And I know developers have kind of settled in and said, okay, this is a new normal. We got to start some projects. The supply and demand for multifamily is off the charts in favor of the owner operators. I mean, I would hate to be a renter in the next decade. You know, Victor, I don't know if you've seen the numbers, but Brookings Institute said there's 5.9 million unit shortfall in housing that started in 2007, and it's just continued to grow. But they think it's going to be 9.6 million units in just 9 years by 2035. So
I've really questioned those. I've questioned those forecasts because I've heard them too. And when I think about, if I look at the major markets, there's a lot of supply. If I think at, Houston.
Temporary.
Right? Houston vacancy is running 10, 11, 12%, especially in new product. Now, I think the shortage that we often hear is the need for affordable housing, but you can't build affordable housing, right? And so it's not an actual shortfall in number of units. And of course, our population's not growing. We're not making enough babies. So at some point, we're going to start to see, unless immigration picks up again, we're not going to see population grow. Where's the demand coming from? I don't know if you have a perspective on that.
I have not totally figured that out myself, but I mean, there still is immigration. There still is, there's, divorce itself, which is, pretty high, is causing a lot of new demand. Gen Z, 53% of them, I believe, of renters right now think they'll never be able to buy because Origin Investments, they say I watched their webinar the other day, they said it's 53% more expensive to buy than rent right now. I've heard other, people say 1,000 a month more, or more than that even. And so it seems like rents are going to go north. I would absolutely, like I said, hate to be looking for affordable housing. I talked to my friend in Richmond the other day. He said developers are quoting, 400,000 a door to build in a nice part of Richmond. And they have to go class A plus, just to try to make those numbers work. They're not building any more mobile home parks, though.
No.
They're not building much workforce housing. So, who knows what AI is going to do to the job market. But it's going to, at any rate, I think that the multifamily, it's going to be a great time to be an operator. But the same risks that cause the current problems, and they're huge, are still there. And that is, read Buffett, read Howard Marks, over leveraging, using risky floating rate debt, overpaying for assets. It's going to happen again as this cycle heats up. I don't know that we're at the bottom yet, but when it heats up, it'll all happen again. It happens every single time.
We've seen the gold rush in so many different new technologies. I mean, I remember being in the .com bubble, and when you're in that bubble, man, it feels really good.
Yeah.
And you can't see it. You
Right.
just can't.
Yeah.
Right?
Yeah, Buffett saw it.
Yeah.
He was on the front of a magazine in 98 or 99. It was called, the headline said, "What's wrong, Warren?" Even his friends thought he was senile. That's 69, by the way.
Yeah.
For not investing in the .com bubble.
Yeah. Fascinating. So how has your investment mandate changed? What are you doing differently now just to respond to what's changed in the market?
Yeah, like you said, we pivoted from being an LP investor. We went to the other extreme for a short time, and we invested in debt. And that was right after interest rates shot up 5 times in 2022. Then we pivoted back to preferred equity. And with preferred equity, we're getting rights and, forced sale rights, budget approval rights, management takeover rights, all kinds of things we couldn't get as an LP. But we had a fixed upside. That fixed upside, though, was really strong. It was like 10% current pay plus 6% accruing compounding upside. I mean, the first 2 deals we did that went full cycle in preferred equity have yielded a 22% IRR. So we were real happy with that in exchange, for having a much more limited risk, limiting our downside. But we pivoted. We didn't like the fact that, going into a potentially stronger market at some point, there was a fixed upside, like I said, 16% generally or a little more. And so we have pivoted to what we call JV hybrid equity. That means we're at the same place in the capital stack. We're in the middle of the stack, meaning that the LPs and GPs are taking the first risk. They're taking the highest risk, but we have an unlimited upside like they do, but we still have the forced sale rights and some of the management approval rights and all that. We're finding that we're doing more due diligence than ever. We build out our team from 1 to 2 to 3 to now 4 people. And Victor, what's so frustrating is the more we build out the team, the more tools we get. We got like 70,000 a year in these tools we bought, like TREP, to really manage our due diligence process. And the more we learn, the more we grow, the harder it's become, not the easier, because we keep finding more things that can go wrong. And the more things we can find that go wrong, the less we do deals. We looked at 1,137 deals last year and only did 6. And Victor, I don't know if they were the best 6, but they were the best 6 that we could find.
Right.
One of the risks, as I told you before the show, is we could have false security if we don't be careful and rely on this structure and do a risky deal and think, well, this deal would have to lose 22% before it would touch our principal. That has happened a few times already. And so we've got to be, super careful to not just rely on the structure, but continue to be extremely careful by finding the right operators and making sure that we're investing in the right deals. And by the vast majority of the time, we've been right.
If someone's coming to you at this stage of the game, it means that the things that bring safety to a project, specifically additional reserves, are depleted. So unless you're bringing those reserves as part of your capital structure, you're still sitting on potentially a ton of risk. How do you mitigate that?
Mm-hmm. Well, first of all, we don't do any form of rescue capital. We're going in with sponsors buying new value add projects or sponsors that have, let's say, 12-year debt at 3%. This is just an example. And they don't want to refinance out of that debt, but they want to capture $5 million in equity, pull it out, and they're at a 2.5 DSCR, debt service coverage ratio. They're at, very, very strong income, very strong reserves. And they say, hey, we'd like to just pull $5 million out of here to go buy another deal. And so we're not doing any rescue. And I think there's a place for that. People like Howard Marks, not in real estate, but in other areas, have made billions doing rescue type stuff, but it's just not
it's not your wheelhouse. Yeah.
Right.
Fascinating. So when I talk with a lot of the institutional capital, when I talk to many of the family offices, the word I often hear in a sentence is the word opportunistic, which that's code for buying distress. And that's all they're looking at. So they're not looking at, I'll say, normal good deals that they would have otherwise previously looked at. And if you can buy an asset for 30, 40% off, there's something to be said for that.
Yeah, absolutely. Yeah, a lot of the operators we work with are looking at those deals. We haven't seen as many as we thought we would, at least in our 1,100 we looked at last year, but we are seeing more. One interesting thing is finding deals that are mispriced or underpriced for non-economic reasons. For example, a large fund, not a mom and pop, but a large fund who took their eye off the ball. They're trying to operate from their desk in New York City. It's out in Indianapolis or somewhere, all by it's sort of an orphaned asset, and they're getting ready to close the fund and they want to sell now. And they might take a significant haircut on that. I wouldn't say haircut, but they would take a significantly lower price just to move it out to a definite, a great buyer who puts a large deposit down. And we've invested in a few deals like that and been very happy with that.
End of fund is one of those things that is often overlooked, which has nothing to do with the property, has only... Right. And look, I remember seeing it in the tech industry, where in post 2000, all of a sudden, a venture capital firm is looking for an exit because they're at year 9 of a 10-year fund, and it has nothing to do with the startup and that company's business cycle.
Mm-hmm. Right. Exactly. Exactly. This is like Buffett investing in the Washington Post in 1973. It IPO'd in, I think it was 70 or 71 at $26 a share, or at least it peaked there. And it was at $1.50 or $2 a share. And Buffett could see that even if you sold it off in pieces, it was worth many, many, many times that. So Buffett bought, Washington Post, spent $10 million, and he got $1 billion in return from that over the years. Again, it was distressed for completely non-economic reasons, which we don't have time to go into here, but it's a great story if you look it up.
Love it. Well, Paul, if folks want to connect, if they want to learn more, what's the best way?
They can reach out to us at our website, Wellings Capital. That's Wellings, wellingscapital.com. They can get some free special reports and even our 26-point due diligence checklist at wellingscapital.com/resources.
Love it. Well, Paul, great to connect as always. And for the listeners at home, definitely want to connect with Paul Moore at wellingscapital.com. The links will be in the show notes. And in the meantime, have an awesome rest of your weekend. Go make some great things happen. We'll talk to you again tomorrow.